Hello and welcome back to the Junior Markets YouTube page. If you're tuning in from YouTube, make sure to check out our website. This is where all of the stuff in this video is going to be posted so that you can get it more in writing as well as look over some other things. So the goal of today's video is part 3 of our 3-part series of what metrics our student managed investment fund uses when we evaluate companies and what our professors like us to use. So today, as you can see, are the shareholder and dividend metrics like dividend yield, payout ratio, free cash flow to equity, and net debt to EBITDA. So we'll be going over these today, how to use them, and some companies and some examples and stuff like that. And one thing I'd like to reiterate before we go into this is when you're using all of these metrics from all the other videos, you have to remember how they are displayed on websites. So things like debt to equity and debt to assets are ratios, return on assets, return on equity are percentages, quick ratio and current ratio are number of times, price to earnings is multiple. So just remember all these things when you're looking at them and know how to read each one. So let's jump right in, and first we're going to be on my website, which under the investing tab, under metrics, are all of the things that we go over in this 3-part series. But we're going to hop on over to Charles Schwab's website, and for these metrics that we're going to go over, which are the dividend ones, we're going to use a company that I did a report on 3 months ago, posted it on my website under Stock of the Day, and did a YouTube video for, American Waterworks. And if you go down to the 3-month chart, we can see that this company is up 16% over the past 3 months. And so not to say that I'm a wizard, but to say that I'm a wizard. And so first off, what we're going to head into is dividend yield. So let's head on down, make sure this company pays a dividend, and it does. So we're going to go into this page, and let's go over dividend yield. So dividend yield, this metric essentially shows how much a company pays out in dividends relative to its stock price. So it's a great indicator for income-focused investors, dividend-focused investors. I did a whole video on how to choose dividend stocks and how to focus on dividend growth, which this company has a great dividend growth because it is a utility company, which means they have great steady growth and solid fixed incomes, because even if the economy is going horrible, you're still going to pay your water bill because you're still going to need water. So when it comes to the dividend yield, if we look down here, we can see that the payout ratio is 61%, which we'll get to, but the annual dividend yield right here is 2.05%. And you get that number by doing annual dividend per share divided by price per share. So say, for example, this company has an annual dividend of $2, and the stock price is $40, then you would divide 2 by 40 to get this 2.05. Now that's obviously not the right number. That was just an example. So this means that a higher dividend yield can indicate a good income opportunity, but it also might be a red flag if unusually high, which means you should always go down and look at the dividend coverage ratio. So the dividend coverage ratio, essentially, if it's over 100%, that means that this company is paying. It's how much net income goes into dividends, so you want it to be over 100%, because if it's 100%, that means 100% of net income is going into dividends, so you obviously want it to be more, so this company has spare net income. So next, what we're going to go over is the payout ratio. So the payout ratio it essentially helps you understand how much of a company's earnings are being paid out in dividends. So this is payout ratio, TTM, which is trailing 12 months, is 61%. And the formula for payout ratio is dividends per share divided by earnings per share. So if a company's earnings per share are $5 and they pay $2 in dividends, the payout ratio would be 40%. So that's how you get this 61% number. And a low payout ratio might indicate that a company is reinvesting most of its earnings into, say, growth, while a high payout ratio could indicate that a company is paying out most of its profits as dividends. So a payout ratio of 40 to 60% is normally stable, but then again, look at the dividend coverage ratio and look at the industry. If it's the REIT industry, then they might have higher payout ratios because those companies have to pay out at least 90% of their income as dividends. So then we're going to head on into the next one, which is free cash flow to equity. Now, I don't believe that free cash flow to equity is on Charles Schwab's website. But if we head down into ratios, we can see. So free cash It is not. So I'm going to go over into Yahoo Finance to get that. So I couldn't find it on any websites, which means you're going to have to go to the statement of cash flows to get it. And essentially what free cash flow to equity is a metric that shows how much cash a company has available to distribute to its shareholders after accounting for capital expenditures, or CapEx, and working capital needs. So if you look at the cash flow statement, you can see net cash, and you can see net cash, and then you can see the purchase of property and equipment and all that, which is capital expenditures. Now, what you do is you do net income minus CapEx minus change in working capital plus net new debt. So if a company has $10 million in net income, net capital expenditures of $2 million, change in working capital of $1 million, and it takes on $3 million in new debt, its free cash flow to equity is $10 million. So a positive free cash flow to equity indicates that a company has enough cash to potentially increase dividends, buy back shares, or reinvest the business, or essentially whatever the business wants to do with this extra cash. However, a negative free cash flow to equity might mean that this company is cash negative after paying for all of these different expenses. So moving on into the last one, which is net debt to EBITDA, which is a widely used metric. This is very popular in our Smith projects and all of the things that when we present. So what net debt to EBITDA is, which it doesn't look like it's on Charles Schwab's website. Charles Schwab's is not giving me a good rep right now. Let me head over onto another website. So now I'm over on Stock Analysis website, and if we look right here, we can see debt to EBITDA with all the other debt metrics and asset metrics. And essentially what net debt to EBITDA is a metric that assesses a company's ability to pay off its debt using its earnings before interest, taxes, depreciation, and amortization, which is EBITDA. So the formula is net debt divided by EBITDA. And for example, if a company has $50 million in net debt and $20 million in EBITDA, the ratio is 2.5. So you just do a little bit of division. But as you can see, American Waterworks is 5.66. And a lower ratio indicates that a company is less reliant on debt to fund its operations. A ratio above 3 might be a warning sign of higher leverage, but then again, you have to look into different industries. So if the industry is very capital intensive, like the airline industry, where you have to spend a bunch of money to get new infrastructure or to build planes or whatever, then this might be higher because these companies need to take on a lot of debt. So it is important to look at different sectors and compare it not only with other companies in the same sector, but compare it to other companies in the same sector. That is going to be it for today's video on the 4 dividend and shareholder metrics. I hope you learned something today. I would like to point out the company I used, American Waterworks. I did a report on them about a month or two ago, and now they're up 16%. And they look like they're going to continue to grow. So this company has had great dividend growth and all that stuff. So if you want to look in on some stock of the days, make sure you look into my stock of the days. I've started posting a little more frequently, but now that school started, it's become a little unfrequent, 3 or 4 days. I'm trying my best. I have a busy schedule. But thank you so much for watching. And again, check into my website for all of these YouTube video updates, stock of the day updates, all that type of stuff. And have a good one.